Ladies and gentlemen, welcome this late afternoon to listen to the inaugural lecture of Professor Phedon Nicolaides, who has been appointed Extraordinary Professor of European Economic Law and Governance in the Faculty of Law. The title of Professor Nicolaides' inaugural lecture is The European Stability Mechanism and State Aid Rules. Professor Nicolaides.
Esteemed Director, esteemed Dean, dear colleagues, dear friends. My speech today will be on the European Stability Mechanism, the Single Resolution Mechanism, and state aid control. Some of you know about state aid, and perhaps it's not so obvious why anyone would talk about state aid in relation to the European Stability Mechanism or the Single Resolution Mechanism, which are European institutions. State aid law applies to the authorities of the state. These are not authorities that belong to the state. So it's not really obvious, it's not intuitive why I have chosen this topic for today. But therefore, I will start my lecture by examining the relationship between the two, by explaining why there is perhaps an important link between the ESM, the SRM, and state aid. But in order to understand really how the rules apply, then the second part of my lecture will focus on what is the purpose of the ESM and the SRM. Unless we understand the purpose, then we won't be able to understand very well how state aid discipline, how state aid rules may apply to ESM and the SRM. Then in the third part, I would look at what state aid rules are, how they have been interpreted in the case of financial institutions, and how they may apply to the ESM and the SRM. And then I will conclude with a number of observations which I think are rather pertinent. Now, let's look first, what's the reason why I have chosen this perhaps unusual subject, the link between the ESM, SRM, and state aid? Well, the system of state aid control that has been established in the European Union aims to prevent distortions to competition, which are caused by subsidies granted by public authorities. Most industrial countries have rules that prevent companies from distorting competition in the market. The market is the source of our welfare, so it does make a lot of sense to have rules to prevent companies from distorting competition. However, what makes the European Union rather unique in the industrial world is that it also has rules that bind public authorities. Why? Because public authorities are equally capable through either regulations or money they dish out to distort competition. And as we will see in a few moments, the ESM, the SRM, and the soon-to-be established Single Resolution Fund have a very simple aim: to provide funding. But if their objective is to finance certain beneficiaries, then this kind of funding may distort competition in the Eurozone or competition in the internal market. And here I understand the internal market the way you would understanding, as covering not just the Eurozone, but the market comprising all the 28 member states. So I think it's a natural question to ask how this kind of funding may distort competition, and therefore how that kind of funding can be prevented from distorting competition. But let's look first at what is the purpose of the European Stability Mechanism and the Single Resolution Mechanism. Well, the crisis that broke out in September 2008 because banks were lending out irresponsibly very quickly mutated into a crisis for sovereigns. Banks had to be bailed out, sovereigns ran into trouble. Why was there a crisis? Well, now there is a narrative that I think most people will subscribe to, that the crisis was caused by a number of factors. First, banks were regulated by national regulators. So regulation was segmented along national lines. National regulators tended to be a little bit more favorable to their own banks, but above all, they ignored the risk that banks were assuming outside their jurisdiction. So that was the first problem. Second problem is that when governments were asked to help, governments soon ran into trouble because instead of running their budgets at surplus or even balance, they were running chronic deficits. They had very high debt. So when they had to borrow more to inject capital in banks, their indebtedness increased even more. Pretty soon, international financial markets lost confidence. That's why yields on certain government bonds rose to stratospheric levels. The other problem was that the crisis also revealed the incompleteness of monetary union. There was a Stability and Growth Pact, which was supposed to instill budgetary prudence. It didn't work. So we had a very ineffective crisis prevention mechanism. And when the crisis broke out, we realized that we had rules that were supposed to prevent the crisis, but we had no rules that could resolve the crisis. So there was no crisis management mechanism. Well, many things have changed since 2008. Now, you can see there, this is a picture I took of a tapestry that was exhibited in the Bonnefanti Museum here in Maastricht. You can see there Northern Rock. Northern Rock was the first European bank that was bailed out in December 2007, before we knew about anything about crisis. So you can see there Northern Rock binging on excessive risk, and the gentleman on the lower right corner, I think is the regulator. You see, he's looking the other side. So the regulators for sure were not doing their job properly when banks were taking in excessive risk. Well, this is supposed to be the past, because since 2008, we've had new rules, new procedures, new institutions. With respect to bank regulation, now there is unified risk analysis. The European Systemic Risk Board is supposed to be doing that. There are new agencies responsible for writing first and then enforcing a single rule books for banks and other financial institutions. We have the European Bank Authority, the European Securities and Markets Authority, the European Insurance and Occupational Pension Authorities. And of course, the jewel in the crown is the single supervisory mechanism, which is now part of the ECB, the European Central Bank. So that deals with bank regulation. With respect to the member states and the discipline that member states are supposed to maintain on their budgetary expenditure, we have the reformed Stability and Growth Pact, which now focuses as much on national debt as on deficit. There are stricter surveillance procedures, European semester. There are new sanctions. So if everything goes all right, there shouldn't be another crisis. And in addition, there is the new treaty, the Treaty on Stability, Coordination, and Governance. Now, with respect to crisis management, we also have the establishment of the European Stability Mechanism. And we do not want banks to access their friendly governments. Therefore, in order to sever the link between banks and sovereigns, there is the Single Resolution Mechanism and the Single Resolution Fund, which are intended to make sure that those who bear the cost are not taxpayers, but the bank shareholders, the owners and the creditors of banks. Now, I also put a little note at the bottom of the slide you see there. That is the intention, to sever the link between banks and sovereigns. I will be telling you later on that, in fact, this hasn't happened. In fact, the new rules do not sever the link completely. The new rules do still request that there is a little bit of involvement of sovereigns, of member states, and I think the reason is because we need to align incentives between the interests of the member states and the interest of the European Stability Mechanism. But you will see that in a few moments. However, if I could stop there, then everything would have gone all right. But as always is in life, new solutions bring new problems. Well, all these new institutions so far apply only to 19 member states. So the membership is limited. If they take action and they fund banks, then there is always a danger that there will be a distortion of competition, not necessarily in the internal market, but between the Eurozone and the non-Eurozone member states. You all know very well that the United Kingdom wants to renegotiate its terms of membership of the European Union. The British Prime Minister sent a letter to the President of the European Council on the 10th of November of 2015, so about a month ago, setting out the objectives of the United Kingdom. The UK is very much in favor of strengthening integration within the Eurozone. But at the same time, they are concerned that this deepening of integration, the stronger bonds between the Eurozone countries, may be to the disadvantage of the non-Eurozone countries. So I quote part of the letter. Mr. Cameron said, "We want to make sure that these new measures that apply in the Eurozone will respect the integrity of the single market." I think, ladies and gentlemen, that that is a very legitimate concern. And indeed, the UK does have reason to worry because quite recently the UK won a legal battle against the European Central Bank, literally a few months ago, because the European Central Bank decided that it would request some institutions called central counter-clearing parties to be established within the Eurozone. Now, the General Court annulled that regulation on the grounds that the ECB had exceeded its competence. Unfortunately, it did not have the occasion to rule on whether the requirement for a specific location was discriminatory or not. I would have liked the court to have looked into it, but it didn't do it. So the question arises, in what sense or how can the ESM and the SRM be prevented from distorting the internal market? As I said, I think that is a very legitimate concern. Now, let's look first at how state aid rules apply and then how they relate to the ESM and the SRM. Article 107 of the Treaty on the Functioning of the European Union, says the following: save as otherwise provided in the treaties, any aid granted by a member state or through state resources in any form whatsoever which distorts or threatens to distort competition by favoring certain undertakings or the production of certain goods shall, insofar as it affects trade between member states, be incompatible with the internal market. So there you have it. State aid is not allowed. We now understand, because this is firmly established in the case law, that a public measure is a state aid measure when 4 criteria apply, 4 conditions apply, and these are cumulative conditions. They must all apply at the same time. First, you need to have a transfer of state resources. Second, that the transfer must create an advantage. The advantage must be selective. And lastly, that selective advantage must be capable of affecting trade and distorting competition in the internal market. However, the prohibition of state aid is not absolute. Why? Because Article 107 starts with the words, save as otherwise provided. And indeed, the treaty does provide something somewhere else. Article 42 provides an exception for agriculture. 93 it's on public transport. 106 is for services of general economic interest. And of course, we have the exceptions in the second and third paragraph of Article 107. Now, the Commission has the exclusive competence to assess compatibility of state aid with the internal market. And the Commission, in many cases that have been confirmed by EU courts, has insisted that any aid which is allowed must comply with 3 criteria: that it must be in the common interest, it must be necessary and proportional, and may not cause undue distortion of competition. So this is what state aid is. Now, how has the Commission applied all these rules? I began counting in December 2007 with Northern Rock. Now, I stopped about a month ago, and I arrived at about 450 Commission decisions. That's a huge number. There is no other sector with so many Commission decisions. The total amount of aid that has been approved, and you are reading correctly, ladies and gentlemen, is 5,763 billion. I repeat, billion. That is close to 6 trillion. Now, maybe you think 6 trillion is not much, or maybe it's too small. It's close to 45% of the EU's collective GDP. And yesterday, when I checked, the GDP of the EU was close to 14 trillion euro. Now, because of the strings attached to any aid approved by the Commission, not much aid has actually been taken up, less than a quarter. Why? Because this is not free money. It's money which is given when a bank needs it, but it's money which comes with, as I said, many strings attached. And the various communications issued by the Commission, the latest is the banking communication from 2013, require member states to keep aid to the minimum, that the shareholders share burden with the taxpayers, that management does not reward themselves with bonuses, so there is always a cap on bonuses, that no dividends are paid out using taxpayers' money, that the banks that get the money do not engage in aggressive promotion of their products, that they do not buy anyone else up, and I like this, that they eventually have to pay back the money with interest. So this is not free money. That's why a number of banks have contested the Commission decisions. I'm happy to tell you that the Commission has won all the cases, except one. I will come to that one. So this is a list. I'm not going to go through this list. This is a list of all the cases that where the Commission was challenged and where the European courts have upheld Commission decisions imposing all these conditions. The one case that the Commission lost was not about the conditions imposed by the Commission, but was about whether there was state aid at all. The Dutch government injected capital in ING Hay, but it was money with strings. So Hay decided to pay back early. the Dutch government accepted lower rate of remuneration. The Commission said, well, I think there is state aid. Ian Hay went to court and won, and I think Ian Hay was right, because the Commission ignored that when you sell your shares, you get rid of risk. That risk has value. So perhaps the Dutch government was right in accepting lower remuneration. Now, the issue that concerns us, the issue that should be taxing us, is the following. The ESM and the SRF, or the SRM, are at EU level. They're dealing with money which doesn't anymore belong to the state. So are we talking about state resources? There is extensive case law on what is state resource. Is any resource, irrespective of origin, over which the state can exercise control. In France versus Commission, which was adjudicated, I think, last year, if my memory is correct, this concerned organizations of French farmers. Farmers themselves contributed the money. Nonetheless, because the funds came under the control of the state, they were considered to be state resources. It's only when there is no state involvement at all, as in Preußen Electra, which is a German case where the German government imposed an obligation on one private party to pay another private party, and where the German authorities had no control whatsoever. But we also know from another case, France versus Commission, the famous Stardust Marine case, that it is not enough to exercise control. The decision must also be attributed or imputed to the member state. So when you have an organization which perhaps belongs to the state, but has other commercial operations, you may not presume that every time that organization makes a decision, that decision is in pursuit of a public policy objective. So you have to attribute or impute the decision to the state. And in this respect, there is the famous Deutsche Bahn case concerning exemption of aviation fuel from excise taxes. For sure, the state lost resources. For sure, there was transfer of resources. But the court concluded this was not state aid, because the decision could not be imputed to the state, because it was mandated, it was imposed by decision of the European Union. It's in this sense why obligatory deposit insurance, which is required by EU law, is not state aid, even though eventually the state may dish out money. So the question for us now is, under which conditions can decisions of the ESM and the SRM be attributed to member states in order to have state aid? Now, let's go quickly first with the ESM. The whole process begins with the member state requesting stability support. But then the Board of Governors of the ESM has to decide in principle, and then it has to authorize the Commission, trust the Commission, to start negotiations with the member state, to sign a memorandum of understanding, and that memorandum of understanding has to contain strict conditionality. These are the words which, in fact, are in the treaty. And the conditionality must be consistent with EU law, including state aid law. Once the Board of Governors approves the memorandum, then the Commission will sign it on behalf of the ESM. I should say here that the Board of Governors always decides on these matters by unanimity. So a member state cannot tell the others what to do. Everybody has to agree. These are the instruments which are used by the ESM. The ESM uses a small amount of capital, 80 billion. It borrows on the international financial markets because it has AAA rating. It borrows very cheaply, and then it passes on the funds to the member state. When it provides direct assistance to member states through loans, for example, I do not think we have state aid, because it's transfer of resources between one public authority and another public authority. However, the ESM also provides loans indirectly via a member state for recapitalization of banks or directly to banks. Here, perhaps, there is state aid. However, the ESM has also adopted a number of guidelines on how it will operate. In these guidelines concerning recapitalization of banks and direct recapitalization of banks, member states have to assume certain liability. For example, when a member state gets a loan to pass it on to a bank, the member state has to demonstrate ability to reimburse the loan. In my view, that means that the member state assumes certain liability. Liability means that perhaps at some point in the future, there may be transfer of state resources. The Court of Justice has said when a member state assumes liability on behalf of an undertaking, on behalf of a bank, then if the bank does not pay a premium for that guarantee, then there is implicit transfer of state resources. And when it comes to direct recapitalization, then the member state is required to participate as well. So this is the structure, this is the procedure. We have two avenues, either indirect recapitalization via a loan to a member state or direct recapitalization directly to a financial institution, where you see that I have underlined the words, that is where I see presence of state resources. So in my mind here, there is no doubt, there is state aid, and that state aid has to be in compliance with state aid rules. In fact, all the ESM decisions over the past 4 years now have been issued with corresponding commission decisions on the basis of the current state aid rules. And I refer to the assistance given to Greece, Spain, Ireland, Cyprus, and Portugal. So no doubt state aid. So to conclude with respect to ESM, the state aid rules apply because the ESM treaty says so, because the Commission is involved, and because the Commission is required to assess any ESM assistance on the basis of the prevailing state aid rules. But above all, I think state aid rules apply because member states indeed are required to be involved in any funding that is granted by ESM to them or to banks. Second part, the regulation that establishes the single resolution mechanism, Regulation 806 of 2014. Well, the purpose of this regulation, ladies and gentlemen, is to prioritize who gets bailed in. We've been talking about the banks bailed out, but that's the past now. In the future, somebody will have his or her haircut. This is a term which is used by financial markets. So if you have to be bailed in, you lose your hair. Who is bailed in? What's the priority? First, the shareholders, then the creditors, then the fund, and lastly, if there is a need, the member state. In terms of decision-making, the regulation says that the board always acts in compliance with EU law and Commission decisions. The board, the regulation says, is accountable. That's unusual, but it says it is accountable to the Parliament, the Council, and the Commission. The board has to act independently, and the board decides by consensus, that is unanimity. Unless there is a problem, and here I'm not quite sure how it works, if it works, that if there is no consensus, then the chairman of the board may decide to proceed on the basis of simple majority. It's in the discretion of the chairman. We don't really have any experience how this happens, but perhaps it has never happened. This is the structure of the single resolution mechanism and the single resolution fund that should be established as of the 1st of January of next year, that is in a few weeks. The board sits within the ECB. A fund will be established. It will be fully capitalized in about 8 years' time. Where will the fund get its money from? The banks themselves. The banks are required to make a small contribution. Slowly, the money will accumulate, and eventually by 2013, 2023, I'm sorry, 2023, the fund will reach its full amount of 55 billion euro. So, this is a picture that should happen, should materialize if everything goes right. We began with huge amounts of state aid. Slowly, that should decline to perhaps nothing as the SRF reaches its full amount of 55 billion euro by 2023. But there is Article 19 in the regulation. And Article 19 says that there should be no resolution without a prior Commission decision. Article 19 I find surprising because it refers to state aid, and I just explained what state aid is, but it also refers to fund aid. I do not know what fund aid, I can guess what fund aid is, but we do not really have any case law on what fund aid is. It means money that comes from the fund. So this is what I find amazing. The Commission will assess both the state aid and the fund aid on the basis of the state aid rules. What's even more amazing, despite the fact, I go back 2 slides, the board has to act independently. Okay. The Commission is empowered to address decisions to the board, both positive and negative. And if the Commission doesn't like what the board has done, it can also instruct the board to recover the aid. So here we have something rather unusual, one EU institution instructing another EU institution, if you can call the Single Resolution Board an institution. And there is also the new directive that its transposition should be completed by the 1st of January 2016, the Bank Recovery and Resolution Directive, which also requires any national resolution boards and national resolution funds to comply with the state aid framework, and that resolution cannot take place unless it has been approved ex ante by the Commission under the prevailing state aid rules. So, what I see, ladies and gentlemen, is a symmetry between the single resolution board, the single resolution fund, and the national resolution funds and the national resolution boards. The only difference, and both the sequence, the ranking in terms of bailing in are exactly the same. First the owners, then the fund, then the member state. The only difference I see is in the brown arrows, where in the case of the Eurozone, member states would collect the money from the banks and then transfer them to the single resolution fund. I also put in smaller letters something else I detect. If there is any danger of distortion, I think, it will not come from the single resolution mechanism. Why? Because that will be applied uniformly by a single entity, the Single Resolution Board, across 19 countries. I think it's much more likely that the decisions of the board will be applied uniformly. I think if there is a concern, it should be with the behavior, with the decisions of the national resolution boards, precisely because there will be 9 of them, and one can never have a guarantee that they will all behave in the same way. But it hasn't happened, so I'm only speculating at this stage. Any experience so far? Yes. 2 weeks ago, the Commission authorized a resolution of 4 Italian banks on the grounds that their resolution, and resolution here means that the bad assets are put aside, the good assets are put in different entities, and then they're sold off. That's what resolution means. In the interest of financial stability. All the money of the Italian Resolution Fund, which amounted to 3.6 billion, so it's not a small amount, came directly from the National Resolution Fund, which was endowed through contributions by the banks themselves. So the money came from the banks. But here, I have no doubt whatsoever that we have state aid. Why? Because the fund is under the control of a national authority. And that national authority pursues a public policy objective. So here, for sure, we do have state aid. The only doubt I have is whether the Single Resolution Board should be considered to come under the control of a member state. There, for sure, it does not. But still, it has to comply with state aid rules. So, to conclude, so that we can have our drinks, I have 4 conclusions. First, perhaps rather unusually, the rules of the European Union on state aid and the state aid discipline do apply to any resources paid out by the European Stability Mechanism, either directly to banks or via loans given to member states. State aid rules also apply to the resources which are managed by the Single Resolution Mechanism or the National Resolution Mechanism. Why? Because they are required to comply, again, with state aid rules. And despite the fact that one of the objectives of the reform of the past 5 years or so, that we needed to sever the link between the banks and sovereigns. In fact, member states are still involved both in recapitalization and in resolution. And I think the reason why they are still involved is because we need to align incentives, because in this way, they also put in their own money, therefore their interests are aligned to the interest of the ESM and the Single Resolution Fund. And eventually, if there is a need, they have to make up any shortfall after the shareholders are bailed in, after the creditors are bailed in, and of course, after the banks received fund aid. So, my overall conclusion is that compliance of these new institutions with state aid rules make sure that there is uniform treatment of Eurozone and non-Eurozone financial institutions, regardless of where the money comes from, that the funding is not for free. In fact, it is conditional and punitive. The beneficiary banks, the beneficiary financial institutions, have to contract their operations, and they cannot do whatever they want. So I think this uniformity and this conditional funding limits distortions in the internal market. That, I think, should allay the fears of the UK Prime Minister. And if I'm allowed to conclude with a more personal observation, is the following. We are now speaking again of multi-speed Europe, concentric circles, different member states doing different things at their own speed. What I find really satisfying, amusing, and ironic all at the same time is that the glue that binds them together when they want to do their thing is the most communautaire of policies, the competition policy, where the Commission exercises powers granted to it directly by the treaty. I think that is a delicious irony. Thank you very much.
Thank you very much, Professor Nicolaides, for this very insightful overview, etc. And I am also delighted that after, as I already mentioned, after all these years here in Maastricht, at EIPA, and then at the Collège d'Europe, and I know that some other people are in other places in these European institutions, we bring back into Maastricht some of all these insights and expertise on Europe. And it's fitting, of course, with Maastricht that we get back here some of the expertise dealing with these various topics, etc. I very much look forward to the coming years in terms of your contributions here to Maastricht University, to our research area, priority research area of Europe in the globalizing world, Europe and the globalizing world, and that we will further be able to count on your insights on both those issues as you explained them today, as well as the many other aspects dealing with European integration. Ladies and gentlemen, may I invite you on behalf of Professor Phedon Nicolaides for our reception, which is, as always, in the refectory outside. If you could follow, please, Professor Nicolaides and his company with the pedal, I would be grateful. Thank you so much, and I close this session.